In this lecture, we're going to talk about how the capital gains tax is calculated. Now, sorry, I must get a little technical with tax words, but bear with me. Capital gains and losses are classified as long-term or short-term. Generally, if you keep an asset for more than 1 year, it is taxed as a long-term investment. If you hold it for 1 year or less, your capital gain or loss is short-term. Now, capital gains tax rates. The tax rate on most net capital gain is no higher than 15% for most individuals and most taxpayers. Some or all net capital gain may be taxed at zero if your taxable income is less than $78,750. This amount could change in the future. A capital gain rate of 15% applies if your taxable income is $78,750 or more, but less than $434,550, or single $488,850 for married filing jointly or qualifying widow or widower. It is $451,700 per head of household or $244,425 for married filing separately. So you get the idea. However, a net capital gain tax rate of 20% applies to the extent that your taxable income exceeds the thresholds that I just mentioned. There are a few other exceptions where capital gains may be taxed at rates higher than 20%. But I won't get into that. You can find this information on the IRS Gov website. Now, the bad news is there is a limit for the tax write-off that you can take on capital gains taxes. If your losses exceed your capital gains, you can only deduct up to $3,000 or $1,500 if married filing separate. The good news is you can carry over the loss into future years. You report most sales and other capital transactions and calculated capital gains or losses on Form 8949. But then this information is rolled over to Schedule D of your Form 1040 tax return. Are you ready to learn how to lower and or eliminate capital gains taxes entirely?